Steve, welcome to the podcast.
Hi, Casey. It's great to be here.
Well, I'm excited to have you on here, Steve. And before we came on, I always like to take copious notes and do tremendous amounts of research. And I had over 3 pages of notes before we, up to about a half an hour ago. And I was like, oh, I got to distill this down. I've never had 3 pages of notes before. I can't have any more than 2 pages of notes. I knew that this conversation could just go in so many different directions with your wealth of knowledge and experience, what's going on in the markets today. We have history. And you've just done so much. You've had so many accomplishments. And I said, nope, we've got to pick one thing to focus on today. So today I wanted to focus our conversation in on your most recent book that was co-authored with Andrew Lo, which John Cochran said was just an amazing academic effort. And that book is In Pursuit of the Perfect Portfolio: The Stories, Voices, and Key Insights of the Pioneers Who Shaped the Way We Invest. And I wanted to kick it off with that. I wanted to ask a little bit about the title itself. And that was, how do we invest today? I mean, can you get that generalized to say, hey, this is how we invest today?
So the title is meant to be this notion that the perfect portfolio is something that we're always searching for, and it's this pursuit notion. And so we can delve into this in a lot more detail in terms of what it means to individuals. But I want us to focus on this notion of a pursuit. And just like the pursuit of happiness, we can pursue what this perfect portfolio might be.
But I'm thinking that pursuit is ongoing and ever evolving, even from some of the leading investors and those in the world of academic research. And it took you about a decade to complete the book, about 10 years to write the book on how we invest today. And as I was thinking about that, I'm going, man, the investment landscape has shifted so much over the last 10 years, just the tools that we can use, and dramatically so over the last 20 years. How do you keep up on the shifting landscape as you try to create a book like this over a decade-long period of time? And that kind of leads into my next question, which is, and maybe you tie these two things together, how long before something is no longer modern?
So those are great questions. So we do the book on a whole variety of different levels. I think on one level, this is it's really a history book. It's a history of what's known as modern portfolio theory, which is kind of an odd title because it really goes back 7 decades to 1952.
And that's what it was. Like, perfect segue to my next question, right? And this has always been one of my big frustrations. To say, how do we call it modern portfolio theory when it's 70 years old?
Yeah, there are challenges with that. I just to give another similar kind of example, I've been involved in helping out with a conference. It's been around for a couple of decades, and we used to call it the Alternative Investments Conference, and then we had to come up with a different title because things that 20 years ago we would think about as alternatives are now more common. So open to suggestions, Casey. If you have a better title than modern portfolio theory, we can try to work that in. But it is something that really is ever evolving. So on the one level, it's a history book and really trying to capture this evolution of thought that really shaped the industry that you and I are in right now. So that's on one level. On another level, it is biographical. We had the great fortune of talking to 10 of my heroes, really 10 of my investment heroes. So that was just the process of writing the book was such a lot of fun. And to get spending time with my co-author, Andrew Lo, that was a blast as well. On the third level, it's really meant to try to synthesize what we heard in our various conversations with these luminaries to see if we could come up with a framework. And so this really, I think, hopefully addresses your question in terms of, well, we did these interviews over 10 years. Is it still relevant? What we hope to end with is a framework to think about how one puts together their portfolio, and so some principles, a process, and what we call a path to the perfect portfolio.
It's funny you talk about your heroes in the world of finance, and for some, their heroes are in the world of NBA or MLS or golf. Like, oh, I got to meet my hero, and it was so exciting to meet Jordan or Tiger, and I had Jeremy Siegel on the podcast here not long ago, and I was so anxious and so nervous because I felt like I was meeting one of my heroes, right?
There you
And then
go. Yeah.
I guess we can find ourselves in the same realm of nerdism here. And it's something that I get
Absolutely.
really excited to do because it's just so much fun. And I want to learn more about these people and more about really the stories of you and your experience in meeting with these individuals. But even before we get there, I just wonder, how did you distill it down to these 10 pioneers? How do you just take all of that? I mean, there's so many individuals that have made such a huge impact in the world of investing and portfolio management and finance. How do you distill it down to just 10 people?
Yeah, that's a great question. And clearly what we wanted to do was we wanted to focus on living individuals, that we could have this conversation. And what would really tie the book together is we asked them all the same question: what's your take on the perfect portfolio? So that limited us. People like the first American Nobel Prize winner in economics, Paul Samuelson, he would have been a great person to talk to if he was still alive. So it was really starting with Harry Markowitz and then trying to find a trail that led from Harry Markowitz to Bill Sharpe and others. That was sort of our thought process. We also wanted to, again, focus on those that were both in the academic world. 6 of our 10 won Nobel Prizes in economics, but also in the practitioner world as well. People like the late Jack Bogle, who made such a mark in terms of the investment industry, and I'm sure we'll get into that as well. So we wanted to have a combination of those who could who really made a mark in terms of this whole process of investing.
Well, and you have some really big names in there, of course, right? We've got Schiller, Sharpe, Leibowitz, Siegel, Fama, Bogle, Merton, Markowitz, Scholes, Ellis. I mean, so many great big names. I'm kind of curious who didn't make the list. Who was number 11, and he said, we can't. It's got to be an even number. We're finance people. It has to be 10.
I really I'm trying to recall how we ended up at 10. You're right. It's a nice round number. I don't think there was really a number 11 that we left off. It had been, as you mentioned, over a decade, so it was time to wrap things up. There were other people that we might have wanted, but declined for whatever personal reasons they might have had. But we are delighted with who we ended up with. That being said, I must say that if we have a follow-up book, hopefully it will have a more diverse group of individuals rather than what I would call, no disrespect, but old white men are a lot of the people who ended up in our book. And I think there it is the next generation of academics and practitioners, much more diverse, that hopefully we'd be having this conversation 10 years from now in a follow-up.
I'm curious about that. When you look at those individuals today, who's the next Harry Markowitz? Who's the next Jeremy Siegel? Who's the next Warren Buffett? I mean, who stands out to you today that you're keeping an eye on to say, that might be the person we write this book on 10, 20 years from now?
Yeah, that's a good question, and no one person springs to mind. I'm on the academic side. What's curious is that we can look back over the decades and we can pick out the 5 major research papers that really had an impact. Those are few and far between. If we get one major paper that really moves the dial in a decade. That's really something, which says something given how many thousands of research papers are published every year. So not sure who's out there. The other thing, Casey, is that sometimes there are so-called sleeping beauties. These are these nuggets of research that don't have an initial impact. Harry Markowitz's 1952 paper is a great example. Really didn't get cited by other academics, really didn't get picked up by practitioners until the late 60s. So there could be something that's happening now, and the full impact of it won't really be realized for a while.
Mm-hmm. Yeah, when you think about all those conversations you had, I'm sure there's some that maybe stand out more than others. Of all the conversations you had, is there one in particular that just pops into your mind when you think about all these individuals?
That's that's a really tough one because they were all great conversations, and I think they all went in different directions. Some where we expected, and some where we didn't. I think the most surprising one was with Myron Scholes, who we certainly know as the co-founder of the Black-Scholes option pricing model, won a Nobel Prize along with Bob Merton, and unfortunately Fisher Black had passed away and almost certainly would have won a Nobel Prize with them as well. But what's lesser known is that Myron Scholes was involved in the development of the first index fund. So he wasn't all just a derivatives person. But what was surprising about our conversation, and it took me a lot of time to unpack it and really digest it afterwards, but his starting point in terms of thinking about the perfect portfolio was very different than most of our other luminaries. We can think of as investors the two key factors in any investment: what's my expected return and what's my risk. And what was fascinating was his focus was really on the risk side, that was really the starting point, that we should try to look at what we want to have in so-called terminal wealth, or the wealth that we want to have heading into retirement, and work backwards from that in terms of how much risk that you should be taking on to try to reach that particular goal. And the other surprising thing was that if we think of sort of a Bell distribution, the sort of normal distribution of expected returns, oftentimes from a risk perspective, we just focus on worrying about how do I try to manage that downside risk. And yet his approach was, yes, that's important, but also think about that upside risk. When should you be prepared to take on more risk when the environment looks favorable? So I think that was the most fascinating conversation, the most unexpected conversation that we had.
Mm-hmm. Yeah, so you had an unexpected conversation there. Someone that was maybe took the conversation in a different direction than others did off the top. But when you look at the different strategies, or ultimately saying this is the perfect way to invest or manage money, this is the perfect portfolio, when you look at all these 10 individuals, who are the two that stands out as the starkest contrast?
So I would say the starkest contrast would be Gene Fama and Bob Shiller. And I think the Nobel Committee intentionally awarded Shiller and Fama the Nobel Prize in the same year. And yet it raised a lot of eyebrows because their perspectives were so different. And really what it centers on is this whole notion of what Fama describes as efficient markets, which simply stated, according to Fama, his classic definition, Stock prices fully and immediately reflect all relevant information. In other words, what you see is what you get. Whatever a stock price is selling for, according to the efficient market hypothesis theory, that's what its value is. And so we can look at that out on an individual stock level. We can look at it on a broader market level in terms of, is the market fairly valued? One term that really irks pharma is this notion of a bubble. And it's fascinating because I looked at one of his earliest papers in the 1960s. It mentions bubbles, I think it's about 20 times, and each time he puts bubbles in quotation marks. He doesn't even want to speak about bubbles. And we contrast that with Bob Shiller, who is known as a behavioral economist. And Bob Shiller's path-breaking research really questioned a lot of the fundamental financial models, including those of Markowitz and Sharpe, that have this underlying assumption that all investors are rational. And what Shiller was able to show is that he took a look at the overall US market, call it the S&P 500, and looked at if investors had perfect information in terms of if they bought that portfolio of S&P 500 stocks and they knew what the dividends were going to be received over the next 30, 40, 50 years, how should they have priced the market on a day-by-day basis? And what Shiller was able to show is, in theory, what the price of the market should have been much less volatile than what we actually saw. And so his conclusion was that there's something going on here that is not rational. And so in Shiller's world, bubbles can occur where we have prices that get overly inflated. A classic would be the late 1990s, the so-called dot-com bubble. And so things got so far out of whack, and then the bubble finally burst and we came back into down to reality. And so Shiller was famous for anticipating what might be happening in the late 1990s, and also just before the financial crisis, Shiller identified something was out of whack in terms of housing prices as well. So I would have to say that the two of them would be the greatest contrast in terms of the 10 luminaries.
I think this is one thing that is challenging for your average investor to come to terms with, because it's human nature for us to want to find the right answer, the best answer. There has to be one way, which is the best way to invest, right? I mean, this was the culmination of the efficient frontier. Hey, this is the best way to do it. And I've got to say that this also reminds me the contrast between all these different 10 great minds. They were all great investors that all had great track records, that all really produced fantastic results at the end of the day. They were all doing it in a different way. And this reminds me of retirement researcher, Dr. Wade Pfau, Bob French, Alex Mergua. You know, all of those three individuals are academics that are deep into not the portfolio management world, but in the retirement income world. And they all three prefer a different retirement income strategy. And I think that's frustrating for a lot of investors and retirees going, yeah, but one of them's the best, right? Well, one of these different individuals, one of these top 10 individuals has it right. They know exactly the best way to invest. If someone's trying to approach it in that way, what do you say to that individual?
That's a great question. And I think this is really what we had to try to digest after we had these 10 interviews. How do you make sense of it? How do you make sense of Fama versus Shiller, to take an extreme example? What we tried to do in the book is to, as best we could, despite our personal views and takes on the world, we tried to present different positions in an as agnostic way as we could. And what we hope the reader will do, and what we hope every individual will do, is to develop your own investment philosophy. And again, to use the extremes, are you a Fama or are you a Schiller? I have my personal views in which I would be closer to a Fama or a Schiller. But even my personal views, Casey, I can't say conclusively that I am right. I'm an empiricist. I look at data. Fama and Schiller are empiricists. They look at the same data. They don't argue over are these data correct or are these data incorrect. They have different interpretations. They have different ways of looking at that. And so it's the same then in terms of what our beliefs will be. Our beliefs should be evidence-based. That being said, there's different evidence out there. What I'm getting at is that start with your investment beliefs, and then you should invest consistent with those investment beliefs. And let me give you an example. So passive versus active strategies, very, very briefly. I'm sure your audience is aware a passive investment strategy would be something like buying and holding an index fund like the S&P 500 as it pertains to equities. An active strategy, and so that would be Fama, buy and hold, something like an index fund, although it's a little more nuanced with Fama. Schiller, on the other hand, would look at ways of being an active investor. And the key dimensions there, I could be a security picker, like a Warren Buffett, or I could be a market timer, which Schiller admits to being, I think, a little bit of both. So I'm not going to say to you, Casey, you should be a passive investor, you should be an active investor. But what I would say is if you believe, like Fama does, that markets are efficient, then your strategy should be one of buy and hold an index fund. If you believe, like Schiller, that markets are not efficient, then you should consider an active strategy. And I know that's hard and perhaps unsatisfying, but I think that's the only way we can square the circle.
Well, there has to be another way. I mean, isn't there? I mean, what do we want to do? I want to take. I look at these guys like Power Rangers. You know, how do we take all of these Power Rangers and combine their powers to, to create the super portfolio? I mean, there has to be. It seems like there have to be some fundamental constants, or, either we combine the fundamental constants across all of them to create the ideal portfolio, or we have a portfolio that uses, each strategy to a certain degree. Maybe it's siloed.
Yeah, so I think there are commonalities. And so let me give you one. I think all of our 10 luminaries would agree that diversification is important. And so we should be diversified. And really, this goes back to Harry Markowitz, who was the first to really provide this framework. It seems very simple now, but as an investor, we should consider our two key dimensions. What's the expected return of securities that I'm looking at, and what's the risk associated with those securities? Simple as that. And so if you can imagine almost a two-dimensional drawing with our vertical axis is our expected return, our horizontal axis is our risk. We all want to be in the northwest corner. We all want to be, all else equal, having the highest expected return and the lowest amount of risk. And what Markowitz was able to show is that diversification is really, I would argue, our only true free lunch, our only way of getting to that northwest corner, of moving to a situation where I can have a higher expected return for a given level of risk, or a lower level of risk for a given level of expected return. So we get that by being diversified across our securities that we hold, diversified across the asset classes. So I think if you're looking for a universal principle, I would say diversification is the key. Another one is looking for ways to lower our costs. and do our investing in as an efficient manner as we can, looking for ways to minimize the tax hit that we are going to have. So whether it's Fama or whether it's Schiller, I think those principles would hold.
That's diversification, keeping our costs low, and minimizing our taxes.
Yeah.
Right. I want to get into how we do this ourselves. You brought some things up earlier that I wanted to dive a little bit deeper into. In the book, you have a checklist of 7 principles to begin constructing your perfect portfolio. And I think that's really important. Your perfect portfolio. Maybe we need to go there quick. How do you define, if you were to define the perfect portfolio for you and anyone in general, is there a 1 or 2 sentence phrase we can say, this is what the definition of a perfect portfolio is?
It's what makes sense for you as an individual at this particular time, given the various factors that you are facing in your life, your goals, your tolerance for risk, and so on.
Yeah, well, that's perfect. That's a good segue, because number 1 on this list is determine how much expertise you have in financial planning and how much time and energy you're willing to devote to managing your perfect portfolio. Now, I question, so I was actually consuming a podcast this morning by Michael Hyatt and going into some research around self-awareness. And some of that research shows that 80% of us believe that we are self-aware. Only 10 to 15% of us actually are self-aware. And how do you get self-aware enough to know what you don't know? Determine how much expertise I have. And how do I get self-aware enough to know how smart or how not smart I really am?
Perhaps the best starting point is, let's assume we're all dumb when it comes to investing. I think that would be the best starting premise, and you better have a convincing case that you are smarter than the average bear, that you have that expertise, be it credentials, be it educational background. So I think my personal take would be, you've got to make a very strong case to not have a financial advisor, not have somebody that you rely on. I feel that I have a lot of expertise in investing, and I rely on a financial advisor. So that's sort of the premise. There are some people, and perhaps those who are heading into retirement, perhaps you've got more time on your hands. It takes a lot of time to devote to managing your finances. And so if you are a surgeon, I would sure rather have you devote your time to the expertise of doing the surgery than to be mucking around with investments that you may or may not have expertise in.
Well, I would believe that some of the best surgeons in the world, I would hope that some of the best surgeons in the world would not believe they know everything, that they would say, I don't know everything. I don't have everything figured out. And they're able to reduce that ego to become the best surgeon in the world. When you look at these 10 different individuals that you interviewed, and these are some of the biggest names in finance, they've won Nobel Prizes, right? Are they able, did you find a constant there that they're all curious and they don't believe that they're 100% right? Or are they all convinced I'm 100% right? All those other 9 guys are completely wrong.
We didn't ask that specifically. Some of them did share or have publicly stated in terms of what's in their particular portfolio. I don't know how many have financial advisors. Some, like Merton, are in the business of providing tools that will help financial advisors. Some, like Bill Sharpe, shared with us screenshots of his portfolio, and it was very simple. Here are 4 ETFs, looking at a world stock ETF, a U.S. world stock ETF, a world bond ETF, a U.S. bond ETF. That's it. Put them all together, combine it with a TIPS product, an inflation protected bond, and there you have it. So it's really different perspectives in terms of their approaches.
But they have to maintain curiosity, right? I mean, I feel like
Absolutely.
that has what, I was asked not long ago, what do you think's led to your success? And I say curiosity and humility. I don't think I have it all figured out. And I want to continue to have conversations like this so that I
Yeah.
can learn more.
So I think a great example, Casey, would be Gene Fama. Gene Fama has been probably, arguably, the most prolific finance researcher, and has had major research papers in each of 6 successive decades. And so what's fascinating is the transformation that Fama has made in terms of what his perfect portfolio has been. In the early 70s, he was one of the first researchers, part of a team that tested Bill Sharpe's famous capital asset pricing model. And his early tests were supportive of the capital asset pricing model. And so Fama's conclusion, and he admitted that if you asked him in the 70s into the 80s, what was his perfect portfolio? It was a portfolio that mimicked something like the S&P 500. Mm-hmm. Fast forward to the early 1990s with his now famous co-author Ken French. In a series of papers, they took another look at the capital asset pricing model and critiqued it and found it lacking. And very, very briefly, not to get too much into the weeds, but the capital asset pricing model says that the only factor that drives prices of individual securities is the market portfolio, something like the S&P 500. So all that matters is how risky your individual stock is relative to that market portfolio. Fama and French said, wait a second, there are other factors out there. We don't know exactly what's driving them, but one of the factors tries to capture the difference between returns on so-called value and growth stocks. Another factor tries to capture the difference returns between small stocks and large stocks. So they came up with what's been known as a Fama-French three-factor model, which has this value versus growth component, which has this small cap versus large cap component, and then has the market portfolio as another factor. What they found was in their research was that when you add in these two other, this value growth and this small cap, large cap factors, the market portfolio factor goes away. And so famously, as Fama shared to a New York Times reporter, their study showed that beta, the risk measure that we grew up with in terms of the capital asset pricing model, beta is dead. So what is Fama's perfect portfolio post that research that he and French uncovered? It's one that is diversified, and the market portfolio is a big part of it, but it tilts toward value stock. It tilts toward small stocks. So there's a classic case of someone whose beliefs, whose thinking have evolved over time based on evidence. And so that's where I think we have to keep an open mind and be aware of what the newest evidence is.
Yeah, whatever it is. I think that's one of the keys to success in an area of life is simply curiosity. Talking a little bit more about risk and jumping down to number 3 on your 7 principles to begin constructing that perfect portfolio. It's find your comfort zone regarding financial gains and losses. And that's one that take some issue with. Yeah, that is, I'm not sure investors really know their comfort zone. And I think great examples of that tend to happen during bear markets. I mean, 2022 is a perfect example of that. We have individuals that a year ago told us that they were, on a scale of 1 to 10, they were 8s, right? And now they go, yeah, I think I was wrong, right? You don't really know what your comfort zone is until you experience the downside of that comfort zone. How does someone really understand what their comfort zone is? Or do they have to experience some loss and really learn what that comfort zone is through not so good circumstances? I mean, can we get ahead of that?
That's a super question, and really a critique of what's a common practice. Know your client, right? You have to try to, through discovery, get some kind of sense in terms of whether your client, what kind of appetite they have for risk and what tolerance they have for risk, more importantly. So let's
Well, and that
suppose.
changes. If we've got 2013, they go from being a moderate investor to go, oh, I'm actually aggressive. If it's a 2022,
Exactly.
they go, I'm aggressive. Actually, I'm moderate.
So that's my point as well. So imagine, Casey, it's a nice summer day. We're sitting outside and we're having a cup of coffee. You present me with a bunch of questions in terms of what my risk tolerance might be, 7-point scale. What if I lost 10%, even 20% on that portfolio? I'm feeling pretty good today, and so I check off. Oh yeah, I could handle that. But when something like that happens, when 2020 happens, when 2007, 2008, 2009 happens, and to give some more of a historical perspective, I would argue that one of the most infamous days in investing history, a bit of a history lesson, is back to October 19th, 1987, probably before you were even born. But what happened on that day, Black Monday, is that on average, U.S. stocks dropped by more than 20%. And that was just unheard of. Up to that point, the worst day had been during the 1929 crash, where stocks had dropped by 12%. So even if we were trying to get some kind of sense of my risk tolerance pre-October 19th, 1987, I might be trying to have a scenario of stocks going down by 12%. I wouldn't have even thought of stocks by going down by 20% in a day. So I think, to your point, yeah, we always have to reframe this, and we have to really think about it. And perhaps, as you point out, maybe you have to experience this. Maybe you have to really feel in your gut what that feels like to have those kind of losses.
Mm-hmm. Yeah, I was reading a Reddit post this morning on Wall Street Bets, and I just love spending time in there. And there was an individual that posted and said that they're very upset with their financial advisor. They hadn't been performing well, underperforming the markets. They're losing money this year. And he goes on to say, my advisor's down 12% this year. I'm firing him. And there are a lot of responses. So, well, that means it's doing pretty well. The market's down 25%. You're only down 12%. But I think most, and many, not most maybe, but many individuals go to a portfolio manager, investment manager, financial advisor, and their expectation is you're going to get all the upside and none of the downside. You should have seen this coming and you need to make changes. What do you say to those individuals?
So first of all, I say something was lacking in that initial conversation with a financial advisor, that expectations need to be set. And I think, Casey, this is where it comes back to investment beliefs. And so what the advisor should be doing through the discovery process is to find out what that individual's investment belief is, and to provide them with a portfolio that's consistent with that investment belief. And so the story you provided, there seems like there was some kind of disconnect. What was that individual's horizon that they shared with the financial advisor? Because if it was a long-term horizon, I would argue the last thing you should do is have an app that tracks your investments, because who cares on a day-to-day basis what your investments are worth? If you look at your investments, I would argue personally, if you look at it more than twice a year, then that's too many times. So something doesn't add up with that story in terms of there has clearly been a gap in expectations.
Mm-hmm. And I think that leads right into the fourth on our checklist, and that is think about your investment philosophy and what you believe about markets. And my question to that would be, yeah, I mean it's really important to find out what we believe, but boy, what we believe is probably wrong, right? I mean, how important is it to uncover what we believe if it's most likely incorrect, right? And maybe that's just a personal bias of mine. It's like, yes, I think it's good to understand what I believe, but it's also important to understand that I don't know what I don't know. And whatever I believe is probably at least a little wrong.
So I would challenge you, Casey, in terms of what do we mean by right and wrong? As investors, we might have a really narrow answer to that. We each have one life to live. We each have one roll of the dice in terms of our investments over time. And, we can look back on it to say, oh gosh, that I did quite well over the last 20 years, or, I'm disappointed with how I did. And so it's really hard to tell with one observation whether I'm right or wrong. Even with a century of data, it's really hard to tell. And so I think I might reframe this to say, what is it we're trying to do with all of this? We're trying to achieve our goals, and those goals, whatever those life goals are, need to be translated into financial goals. And then our portfolio is formed to try to achieve those financial goals. So whether I'm quote unquote right or wrong, whether I take in, for example, an active strategy or a passive strategy, perhaps in both of those cases, I can achieve my goals. And so that's another way to think about what we mean by right or wrong.
So it's mostly, it's not that we're trying to discern what the right answer is in buy and hold an index fund versus an active strategy, passive or active, but do I believe whatever strategy that I have chosen can help me reach my goals? That's really what we're trying to say.
Absolutely. That's how I'd like to reframe it. Exactly.
That's great. And I also wanted to talk about the next one on your list there, which is list all the assets that you have and here, most importantly, and the assets you are willing to hold, such as mutual funds, ETFs, stocks, bonds, real estate, so on. And one of the questions I had around there is, just because you don't want to hold it, does that mean that you shouldn't hold it? You go, well, I don't want to hold equities. Yeah, but does that mean that you shouldn't hold it?
So I think this is all part of the whole process. So that should be your starting point. As we then move from the what we call the principles to the process to the path and where you end up, which is your actual asset mix, which is what we are talking about in terms of the so-called perfect portfolio. If that portfolio, let's suppose in an extreme, you don't want to hold equities, as long as you can still meet your financial goals without holding equities, all the power to you. I think all that's great. I think it's always this evolutionary process. I'm sure many of your clients, many of your listeners are very intrigued about crypto, and should that be part of one's portfolio? And or should that be something that you exclude as part of your portfolio? And this is where I've thought about that, and I'm an evidence-based person, so I was curious, and in one of the blogs that I write, I put together as much data as I could on Bitcoin, just to really understand the risk and return historically of Bitcoin. And my conclusion was that looking at Bitcoin compared to even a diversified portfolio of stocks, from a risk perspective, we're talking 10x, 10 times the risk. And so today, at this point, I made a personal decision that crypto, it doesn't make sense for me in terms of my portfolio. So that's the kind of process I would like individuals to go through to come to the conclusion that any investment is part of or is not part of your potential set.
This makes me think of, Buffett's invest in what you know, which to me, it seems to be pretty dangerous advice, especially if you have a very narrow, scope of expertise. If I really only understand car mechanics, should I only be investing in car mechanics, right? What do you have to say about that old adage?
So Buffett's a great example. In the late 1990s, Buffett avoided the whole .com, quote unquote, to use Schiller's term, the .com bubble. Fast forward, and Berkshire Hathaway is now investing in tech stocks. I believe, correct me if I'm wrong. I believe they have a big stake in Apple, for example.
Well, he recently ventured into crypto as well.
And well, there you go. So I think that's an evolutionary process, and I think the process, I don't know for sure, but the process that Buffett went through as a very thoughtful individual is looking at these things more deeply, looking at the evidence, and looking at what made sense. Another example, what Jack Bogle shared with Andrew, my co-author, in interviewing for the book. Surprisingly, in his portfolio, he had a small portion of gold that he held. It wasn't all just low-cost index funds. So it's really trying to be open, but really give a lot of thought in terms of what you're prepared to invest in.
So if you're going to venture into something that is new to you, that you're not that familiar with, then educate yourself on it before you pull the trigger.
Absolutely.
And I want to touch on the last one of your 7 here before we move on, and that is avoid obvious mistakes. And that always makes me, well, if they're obvious, I wouldn't have made the mistake, right? Where you think about this on the golf course, like, yeah, I know I shouldn't have hit it out of bounds, but I didn't know that I was over here and that was going to lead to this. And how do we avoid obvious mistakes? Again, if they were obvious, we wouldn't have made them in the first place.
So the biggest category of what I would put under obvious mistakes are behavioral mistakes. The biases that we have, and this is kudos to Schiller, to Dick Thaler, another Nobel Prize winner, to Daniel Kahneman, another Nobel Prize winner, who really brought us to understand more about ourselves. One of the biggest biases that we have as individuals, and in particular as investors, is overconfidence. There have been classic surveys. Rate yourself as a driver. Are your abilities above average or below average? And 80% of respondents claim to be above average. And the same goes for investing as well. We have this overcome. I've done some of these surveys, and I'm as guilty as the majority in terms of having overconfidence. What studies have shown is that the way this translates, and by the way, there are gender differences. Males tend to be more overconfident than females. What that translates to as individuals and investing is overconfident individuals tend to trade more. The result of excess trading is underperformance. So there's this clear path from overconfidence to excessive trading to underperformance. So that's a clear bias. And if we can get our heads around that, then we can manage these biases, or try to manage these biases. And it's not individuals only. Studies have shown that professionals have these biases too.
So one of the best things that we can do, and I love this, one of the best things that we can do as individual investors is understand obvious mistakes, but that really comes down to understanding our behavior, having a better understanding of behavioral finance, of which we've had many great conversations around behavioral finance. There's a lot of great books and resources. If someone does come to you and says, hey, I want to avoid obvious mistakes, I want to get better at understanding my own behavioral risks, what direction do you point them in? Do you recommend any specific books or resources?
I think the one that comes to mind is Daniel Kahneman's Thinking Fast and Slow. Another one is Thaler's book, co-authored, called Nudge, where they focus on a lot of behavioral examples and experiments that really uncover the biases that we have. And I think there's a bit of prescriptive nature to these books in terms of what we can do. I think the first step in anything is self-awareness, is to realize that we've got these biases. I'm Steve, and I have these biases, and let's start there, and then we can try to overcome them.
Yeah, well, and we'll make sure that we put links to those books in the show notes at retirewithpurpose.com. Let's get to you personally. And I was curious, you and Andrew went into this research project, took a decade. You had to learn a lot. I mean, you already knew a lot, but you still had to learn a lot from these conversations. And I'm curious, anything specific that you or Andrew, maybe both of you, changed about the way you invest after completing the project?
I think it's just the revelation that, and spoiler alert, there isn't just one perfect portfolio. That we all have our own perfect portfolio, and that perfect portfolio changes over time. It should be changing over time as our circumstances change. So just how important all of the personal factors are when it comes to investing. And Charlie Ellis, I think, really unpacked this well. And he's a big proponent of low cost index funds, and was actually one of the first individuals to publicly come out against a totally active approach. But he really said that you and I, Casey, we are different individuals, and we have different backgrounds, we have different views, we have different tolerance for risk, we're at different stages in our life, and so our portfolios, by definition, have to be different. We're looking for different things. So I think what really struck us is this really comes down to a personal pursuit with assistance. I don't mean to do it on your own, but where we're going to end up is going to be different for each of us. And back to some of our parts of our conversation, is your approach right? Is my approach right? Maybe we're both wrong. And I think that's okay, as long as we can both be approximately right. If we're approximately right, then really, I hope that we'll both be able to obtain the financial goals and the financial freedom that comes with achieving those financial goals.
But I'm curious, when you look at these 10 individuals, I mean, is there one philosophy that is as close to Steve as we can get? And the same goes for Andrew. Do you two follow different philosophies? Do you two prefer one of these individuals' philosophies over another? And if so, who?
So I would say for me, it would be, my philosophy would be closest to Bill Sharpe. He came up with this capital asset pricing model that really the conclusion was all that matters is this market portfolio. So buy and hold this market portfolio. And I've shared with you his simple approach: 4 ETFs plus tips. There it is. There's your portfolio, and it's very straightforward. Another great book, I'll give a plug for my co-author, Andrew Lowe, and how his philosophy differs. Years ago, he came up with what he called the adaptive markets hypothesis, and he has this great book that I'd highly recommend called Adaptive Markets. And so his take on the efficient markets hypothesis is that it's not really wrong, but it's incomplete. Incomplete in the sense that we have to take into account all kinds of evolutionary type of things. And so this efficient market really is always evolving. And so I think Andrew would have this premise of starting with efficient markets, but making sure we are more adaptable as scenarios change, as our view of risk might change as well, given different scenarios. So I don't want to speak for Andrew, but I think that would be something that would be more distinctive for his approach.
I see. It's always something to just continue to hammer home. Anytime we interview two amazing experts, they always have a slightly different approach. And so I can really appreciate that. So the question of the day, given today's market climate, economic climate, are there any particular lessons that you think we should be focusing in on or pulling from these 10 academics that might be especially timely today?
Sure. I would say 3 things. One, I would say don't panic. It's been, here we're speaking in October 2022, and it's been a terrible year, not only for equities, but for bonds as well. Don't let your emotions take over. Don't be that person that you just described in the Reddit forum that wanted to fire their financial advisor because their portfolio was down 12%, which I think you and I agree with is a pretty good result so far this year. So that's one thing. The second thing I would say, and in particular for your listeners who perhaps like myself, we're getting close to that magic typical retirement age. Despite that, think long term. I hope that when I soon hit 65, I hope that my investing horizon is still going to be 20 plus years. And so there's going to be a lot of ups and downs in the next 20 years. So as long as I have a long-term focus, as long as I'm aware of, what might happen if there's a really bad year and stocks and bonds are down by 20%, do I still feel okay by keeping that steady course? The third thing that I would say, and this is where Marty Leibowitz has made a lot of contribution, is we're transitioning now from a really low interest rate environment to a high interest rate environment. And in the short term, there's a lot of pain. It often seems counterintuitive to investors, but when interest rates go up, bond prices go down. And so that's where we've seen bond prices go down in 2022, coincidentally, as interest rates are going up. So we're all feeling that pain. But eventually there are going to be some benefits, in particular for those who are relying on a fixed, steady income for savers. That's going to be a good thing in a higher interest rate environment. So hang in there.
Well, I appreciate the glass half full thoughts there. Well, as we come to a close, I want to make sure we tee up your book for our listeners, and we want to give it away. We partnered up with Steve. We got a bunch of copies of his book here, and we want to give them away until they're all gone. So if you'd like to get a copy of In Pursuit of the Perfect Portfolio, the stories, voices, and key insights of the pioneers who shaped the way we invest, all you have to do is shoot us an email after you subscribe to the podcast and write an honest rating and review over on iTunes. Shoot us an email, info@howardbailey.com with your iTunes username. We'll shoot it out to you for free. Stephen, thank you so much. It's been a true pleasure.
Likewise, Casey. Glad to chat to me.